Are you currently investing in ETFs or exchange traded funds? If you're not, now might be the best time to get into them. And in today's video, we're going to be breaking down the acronym, exactly what it means to have an ETF and why you should be getting into these. Now, when you think of exchange traded funds, it's almost what would happen if a mutual fund and a stock had a baby together. It's a pooled investment vehicle where you can contain kind of the best of what a mutual fund brings and what stocks have to offer. But there are some pros and cons to these, which again is kind of what we want to break down and making sure that you know what exactly exchange traded funds are. Now, an exchange traded fund is a basket of holding of a variety of investment that a manager chooses. Now, financial advisors can create ETFs on their own, like we've seen with Catherine Wood, and unfortunately, her ETF is not doing well at all. But when you can find an ETF with just 25 of social media's favorite companies, you can put all those together. That can be your basic in an ETF that exists for a particular interest. Doesn't really make it a good investment depending what you put in there, because a lot of people put companies in there that they really think are going to do incredibly well. And unfortunately, they do poorly. Like I said with Catherine Wood, the portfolio or the ARC ETF that she is running is down about 68% since its inception, which is kind of crazy. But when you start thinking of how other ETFs work, simply like the S&P 500, where it is an ETF or an exchange traded fund that is following the performance of a specific index. So essentially, it is holding the exact same stocks that are held within that index itself, making it a really good strategy. When you think of an ETF such as the VOO, it is instant diversification, putting it and really investing in 503 of the largest companies within the United States. So it's pretty neat how an ETF works. Now, working very similar to a mutual fund when it comes to individual stocks, when you start looking at an ETF, it may look, again, kind of similar to a mutual fund, but the thing with the mutual fund is it can come with a bigger price tag. It can also come with a bigger management expense. That is the reason why I know Dave Ramsey always pushes towards the mutual funds, but I push towards the ETFs. Now, the other big thing with ETFs is they can trade throughout the day. Now, a lot of people might not know this. When it comes to conjunction with mutual funds are only traded at the end of the day, where ETFs or the value of the ETF can be changed and exchanged throughout the day, which makes a big thing. So ETFs can trade at a premium or a discount depending on the time of day that you're buying them, because if it gets towards the end of the day and it's a much higher value, then you're going to be paying a much higher premium on that mutual fund if you do have to wait to the end of the day versus buying the ETF when it is available or when you want to get into the market. Now, the question comes ETFs versus stocks. So this is a little bit different. So although ETFs trade like stocks, they can even be made up by a collection of stocks like we see with that VOO. They are not the same as owning the company itself. Now, I want to explain exactly how we think about this. So owning a stock, let's say Coca-Cola, Nike, a publicly traded company, when you buy stock in the company, it gives you a piece of the company, even if it's a small piece, if you just own a couple shares, and those shares have certain privileges, such as voting rights. Now, of course, when it comes to ETFs do not have voting rights. For instance, again, and I'm always going to use the point of reference of the VOO, you have NVIDIA in there, you have Apple, you have Microsoft, you have Alphabet, you have all of these companies. Because you own it in an ETF, you do not really have no voting rights within those companies because you are owning it in that ETF and not the individual shares. When you buy the ETF or own a piece of an ETF, not the securities within the ETF, that is the big difference. You are not technically owning the companies that are enclosed within that ETF. You are just buying and holding the ETF itself. For example, if you have a share of an ETF that holds Coca-Cola, you own a piece of the ETF, you do not own a piece of Coca-Cola. You cannot vote on anything that the company really has and presents to its stockholders because you do not own Coca-Cola. However, the caveat to that is the ETF managers may be able to vote in your place, essentially from not having it. You'll still profit from Coca-Cola from the stock going up. You'll profit from the dividends that Coca-Cola is paying, and the ETF and the fund manager will pass it along to you and the other investors that are invested in the ETF. Again, very similar to a stock, but the big part of that is some of the trading commissions or the fees that could be associated with it, in addition to not having and removing those voting rights. So how does an ETF compare to a mutual fund? Now, these two are probably two of the big securities that are very, very similar. When you think of ETFs and mutual funds, they are pooled investment vehicles. So putting all of those together. And the key difference is one, how they're traded, like I said, and what they cost. This is where it comes in. So mutual funds, like we had noted earlier, they trade once a day at the market close. So if you place it, let's say at noon, if you place it at 9 a.m. to buy a mutual fund, it is not going to purchase it for the entire amount of day, which you really don't know what price you're paying for the mutual fund until the market actually closes that day and knowing what that final price is. Now, of course, if the price skyrockets, you just missed out on all of those gains. If the price does dip, you just bought the mutual fund cheaper. So it can have kind of its pros and cons when it comes to that. Now, when it comes to the mutual funds, again, it is very specific on dollar amounts. They don't have the fractional shares that we see with ETFs. So you can't buy, a 0.01%. It is a $50 fund funding of X. And the compensation, mutual funds, again, are full dollar amount. So if you're looking to get in, could be a little bit more expensive. As with stocks, you typically buy ETFs on a per share basis, although a lot of brokerage firms, including M1 Finance, which we have down below, have a dollar-based investment. So again, you can buy those fractional shares of the ETFs. Now, of course, mutual funds, very similar to ETFs, both of them have management costs or an expense ratio. So a company putting together different ETFs can make you pay money somehow. That is the expense ratio that we see. And it's very important when we start thinking of a 0.03 like the VOO, very, very cheap when it comes to an ETF. When you start looking at the mutual side of it, mutual funds run usually about 1.5% for the mutual funds because they are managed funds. Now, mutual funds could also have other charges that you have to be aware of as sales loading, distribution, marketing fees, or redemption fees if you buy or sell those mutual funds. So definitely do your own research, know exactly what you're investing in before you get into it. So some of the questions that I get, number one, do ETFs pay dividends? Yes. If the ETFs do pay dividends, they can pay it monthly, quarterly, really whatever schedule the ETF manager chooses. Thinking of like a JEPI is one, for instance, that does pay dividends and it pays it on a monthly basis. So not similar to like an HD. When there is a qualified dividend every single quarter, you do get a return from that based on the bucket, and of course could be eligible or acceptable to capital gains tax. So again, know exactly what you're getting into. Types of ETFs, this is where it gets very, very interesting, which I invest in passive ETFs. When we think of passive ETFs, you're thinking of the market index like the S&P 500, or even thinking of something like the QQQM that follows the NASDAQ 100. It is following an index. It is not going to be actively decision about what to buy, what to sell, what's going into that ETF. It is just going to follow it and really hold the exact same weighted average, what you have within that index itself, and that is going to build the ETF. Now, there are also active managed ETFs. Now, the thing with active managed, this is where the fund manager or the one that is running the ETF does the buys and sells when they see fit, and they can do adjustments to it. They can do trades, they can do changes, and they are doing it to really ensure that the ETF does better than the S&P 500 because you always want to try to beat the market. Now, for example, on this, an active ETF could provide a little bit of a higher return in the bull market, minimizing or changing the stock portfolio that's in the ETF within a bear market, or provide higher dividends depending what you're in. And of course, the big thing with active ETFs is a majority of them do have a much higher expense ratio because of that cost. Now, there are also stock ETFs, which again is built of complete stocks in the companies. The S&P 500 ETF is a stock ETF that can hold thousands of stocks or just a handful depending on exactly how they built it. Rather than just holding one stock, you can hold a basket of stocks, which comes to some of the industry sectors. Even let's say, for instance, you want to invest in artificial intelligence and only in AI. There are ETFs that kind of encompass all of the companies that are embedded in really building, development, implementation of artificial intelligence. You can really break it down into sectors, looking at, if you want international, if you want small cap, if you want large cap, if you want industrial, if you want finance. There are so many different ways that you can split all the essentially stocks we have within the stock market to build the ETFs. This can be the exact same when it comes to bond ETFs, very similar to what we see with stocks. They can do the exact same thing with bonds. When we start thinking of government bonds, corporate bonds, short-term bonds, long-term, domestic, international, there is a different bond manager, different ETF, similar again to putting together all of those stocks. they are putting all of the bonds into the ETFs, but there are also commodity ETFs, there are sector ETFs, leveraged ETFs. There are so many different varieties when it comes to ETFs. And essentially, like I said, they're taking all of these companies, they're bundling them in a very different methodology. And really, the fund manager or the individual that is running the ETF is responsible for what is happening in that ETF. And again, going back to Catherine Wood with the ETF with ARK Investments, unfortunately, I don't know why there wasn't any changes or anything like that, but that is one I know that some people have commented on how that performance and really what it is. So to sum it up, guys, when we start looking at ETFs, some of the pros: accessibility. When you have a brokerage account, just like M1 Finance, you can get into ETFs, easy to trade, very transparent. And of course, they have a really big tax efficiency when it comes to ETFs, a lot more tax efficient than mutual funds because the ETFs tend to have lower capital gains distribution, which are taxable to investors. So make sure you do your own research. But on the flip side of this, and the cons, commission. Sometimes when buying or selling ETFs, there could be a commission. The bid-ask spread, this is another one. You have to make sure you know the ETF, really the create and the ownership, who owns it, who manages it. Do you trust the individual that runs it or that manages it? And what exactly does it look like? So some of the ETFs, depending on the ability, they also talk about illiquidity. So when you have an ETF and if there's very low trading volume, you might not be able to unsell or sell the ETF itself at a fair market price, or you might have to take less for it. And of course, the closure risk. There's also a possibility that an ETF you buy could just close. And if you're unable to bring in enough assets to cover its operating costs, you could be responsible for them. So guys, ETFs are the only way that I invest. Now, the reason I do not own the individual shares is one, I don't look and really dig that deep into a Warren Buffett level when it comes to owning individual stocks. ETFs keep it very simplified. They keep it very hands off. I'm not one that wants to spend, 3-5 hours a day looking into companies, looking into projections, portfolios, whatever it may be, even looking at prospectus. I don't want to spend the time and effort to do that. I would much rather be invested into something like the Vanguard S&P 500. Putting everything in that VOO really makes sense. Even when you look at Warren Buffett, he said 90%, and it's been proven through time, 90% of financial advisors cannot beat out the market over an extended amount of time. So if you think about all of the fees and everything you pay to a financial advisor, you might want to second guess it and think about what ETFs do have to offer. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.